Very important two charts that we're looking at. Neither one of them are simple price charts, which everybody is deluded by one way or the other. That's why there's a chorus of folks still calling every time the gold flinches, it's got to correct, etc., or it's the top. There is a relationship between gold and the S&P 500 or the U.S. stock market bubble, and you can plot it. It's called a spread relationship. We simply divide the front month of active contract of gold futures into the price of the S&P and express that as a percent. And we plot it, okay? Every end of every month, we plot one little dot, okay? When you plot that chart, we've shown it in prior reports, you've got a 11-year wide base on that chart, where gold back in 2011 was at a higher relative level to the S&P, and during its bear market, 2011 through especially 2013 through 15, gold dropped, but also its relative performance dropped to the S&P. But then actually since 2014-15, you could basically take that same spread chart, draw a line sideways, and gold's been above and below and above and below. It's really been par to the S&P. Depends on when you bought gold relative to the S&P, you're doing better. Now, especially since 2024, that spread has moved up sharply. Now, when you look at the spread chart, there is a massive, very clear line across every single rally high that relative performance surges have created. So you could take a crayon and have a 5-year-old draw the line for you. Unfortunately, most people don't plot the spread chart. And if you did, you would see that this month's close, we have a half a day trading left, I think on Friday, is out above that base, meaning that while gold has handily beat the S&P, especially since 2024, coming up from the lower end of that base, it's now punched out above it. So if you were just looking at that chart and I erased the words gold versus S&P and didn't tell you what it was, and you thought, well, that's a price chart of some stock, you'd say, I got to buy that thing, okay? Because you break it out of a base that an idiot could see. But everybody thinks that gold has gone too far, it's got to correct, or it's excessive. And that's because they're focused on what? A simplistic price chart. And when you run a relative performance chart, it's saying not only has money been moving into gold since 2024 soundly, solidly, it's now breaking out. Meaning that the money flow that we've seen coming out of doubters in the stock market, some large skeptical asset managers, let's assume, have said, hey, I need a little bit more in that monetary metal sector, okay? And they've been, a little bit here and there. And it's helped gold go up. But when you break that spread out, and you're doing it this month, we're at levels now that are incredibly above that breakout point. It says, hey, it's just beginning. This relative performance asset shift out of the stock market into monetary metals is only now beginning. So those folks who've been tell you that, oh, this has gone too far, too long, et cetera, they need to look at that chart because it says something totally different. There's another chart we can talk about if you want to, unless you want me to pause a bit here. If you plot silver versus gold spread chart also, where you don't look at the price of silver, you don't look at the price of gold. Instead, what you do is you divide the futures contract December silver right now into the price of December gold, and you express the answer of that as a percent. You'll see that we've developed a spread chart basing action, much like that gold versus S&P basing action, where, silver's had a surge back in 2020. You recall that move where silver went from like $15 to 30, and gold only went up about 40%. Well, silver outperformed up through late 2020. And then we went into that multi-year period where, gold went sideways through early 2024, and silver and the miners actually sort of declined in relative performance. No, they were going up. There was a rise, net rise there, but they were underperforming gold, the mama metal. Silver has been surging versus gold since early this year, about April. It's really come up sharply on a relative basis, so it's been a better place to be, net on balance for the year. But you're challenging now a massive spread breakout base. For not only is gold saying, I'm going to break out versus the stock market, silver saying, I'm going to break out versus gold on a relative place to be. And so if the monetary metals are now moving into a fresh, massive asset class shift versus the S&P, the U.S. stock market, silver is also saying the same thing, except I'm no longer going to be the little dog that follows behind gold. I'm going to outpace gold. So if you're going to shift to monetary metals now, and if you're not in these markets, for example, a lot of people aren't, I'm suggesting, MSA is arguing, that the metrics that we're talking about here are saying something big is about to begin in terms of asset class shift, favoring monetary metals, but especially silver. And it's starting now. We've seen congestion in silver since October. So we've had 2 months of they sell it, they drop it down, goes back up. They sell it again, drops back down, goes back up. And now for the third time, we're pressing up into the lower 50s. We're $53 now. By the way, we'll rotate our analysis now to March silver starting the 1st of December when December silver goes into delivery. Also, we'll be shifting out of December gold and shifting to February 2026 contract. And already, when you look at the March silver, it's up to 53.5 area, meaning it's almost ready to touch top tick again, which is 54 in that recent rally on a $1 scale. But that's not the issue to us. The issue to us is that relative performance breakout, gold, S&P, and secondarily, silver says, okay, yeah, the monetary metals are going to go up, but this time I'm not going to be behind you, I'm going to lead. And I think the same applies to investors who don't want to necessarily buy silver futures or calls on silver ETFs, bullion ETFs, or buy silver bullion. They want to buy miners, they want to buy stocks. We technically analyzed that highly likely that not just in the immediate surge we're about to see, and remind me to get back on that subject again in the next 6 months, but over the next year or so, the miners will be gold as well, especially the silver miners relative to the gold miners.
Look, for years I've tried to explain to people that price alone is the least reliable tool you can use when attempting to understand where a market stands in its long-term structure. Price is emotional. Price can be manipulated. Price can be deceiving. But structure, momentum, relative performance, those things don't lie. They whisper long before they shout, and right now they are whispering something that almost nobody in the mainstream financial media seems to hear. Probably because they're still staring at simple price charts waiting for the next blip to validate whatever narrative they walked into the room with. But what we're dealing with today is not a blip, not a pause, not even what you'd call a healthy correction after an extended move. No. What we're dealing with is the birth of a structural shift that has been building beneath the surface for more than a decade. And because most people aren't trained to see structural pressure, they confuse every little dip with a top and every little rally with a trend. It's like giving a cardiogram to someone who only speaks in emojis. So let's get to the heart of it. The first chart that should grab your attention is not gold's price chart, nor silver's, and certainly not the headlines screaming about overbought or parabolic. No, the chart that matters right now, the one that confirms everything I've been saying, is the gold versus S&P 500 spread chart. For those who haven't followed my work for years, this is how we measure whether gold is gaining or losing structural ground against equities. Not based on emotions, not based on CNBC enthusiasm, but based on the actual flow of capital. And when you divide the front-month gold futures contract by the S&P 500 and plot that percentage every month for the last decade, a very clear picture emerges. Since 2014, gold has built an 11-year wide base of relative performance against the S&P. That means for 11 years, gold has essentially held its position, sometimes outperforming, sometimes underperforming, but always within a defined band. You could draw a ruler through the middle of that range and capture a decade of quiet coiling. That's not noise, that's structure forming. Now here's what matters. In 2024, that structure began to lift. And in 2025, it accelerated sharply. And this month, right now, we've finally punched out above that 11-year ceiling. Let me emphasize this for viewers. When you break a base that large, that clear, and that well-defined, you are not looking at the end of a trend. You are looking at the beginning of one. If you erase the labels from this chart and showed it to any competent technical analyst, they would say, that's a breakout from a multi-year base. You buy that. Yet because the words gold versus S&P appear at the top, suddenly people forget every rule of market structure they've been taught. The mistake is universal. It's the same crowd that thinks every $30 dip in gold means the top is in, and every rally is an anomaly. They don't seem to understand that momentum precedes price and relative performance precedes momentum. By the time the price makes its final run, the shift has been underway for months, sometimes years. What we're witnessing isn't exhaustion, It's ignition. Gold is not overdone. In fact, structurally speaking, gold is just beginning. Now, once you understand that the monetary metal, the mama metal, is breaking out against the S&P, you can begin to appreciate what's happening under the surface in silver. Because silver isn't simply going along for the ride this time. It's beginning to do what it did in 1979, what it did in 2011, and what it has historically done during the most intense phases of monetary realignments. It accelerates past gold.
When I speak personally, and I show my position in every report as a disclaimer, I'm heavily into silver-related. Calls on SLV, double long AGQ, which is a bullion ETF, but also silver miners. And I'm buying a lot of junior miners now, silver miners, because I think they could be hotter than silver, much hotter. They're extremely neglected. It's a very tiny little sector. And when the hands come in to buy it, money fleeing the stock market or deciding it's a better place to be, monetary metals, those little miners just go vertical. I've seen a lot of days lately where silver's up 2% and they're up 5%. So I think that's what's going on. But as far as silver, it's in a fairly unique situation, has really partly to do with this broader view of monetary metals going up. But think about this for a minute. Silver's been stuck in a range, 50-buck highs in 1980, 2011, and even recently either side of 50, for 50 years. What's going on here? I can go show you a chart of copper. Go back to the 70s, 1980s, 1990s, into 2000. And in 2007, after multiple decades of horizontal reality for copper, it broke out, and within a couple quarters, it quadrupled in price. It's late 2005, 2006. And yeah, there was a sharp sell-off after that, but you then, hence, after that surge, a quadrupling in price, you lived in a multi-decade range that is like 3 to 4 times the average price of what prevailed the 70s, 80s, 90s, 2000 for copper. Same is true for lead. Very exciting metal, right? It lived in a multi-decade range, and in 2007, not in sync with copper, a year and a half later, it quadrupled in price in a couple quarters. And since then has lived in a range that's roughly 4 times the price average of that prior multi-decade range. Why is silver still stuck in its 50-year range? Well, there's fundamental arguments for that. Manipulation, attempt to control by some major banks, no doubt with the nod of a head from the Fed and so forth. But when a market makes a mistake, like we've seen stock market bubble tops, and that's when the stock market makes a mistake of, let's say, going too high for too long. Even though the truth underlying the bubble is valid, it's overdone it, like the dot-com high. And so when it corrected, quote, corrected, S&P back then dropped 50% by 2002, but NASDAQ 100 collapsed 82%. Despite the truth of the reality of internet changing our lives. It was excessive for too long. Silver, we argue, has been in the same position except on the downside. It's been too low, too contained for too long, and when it finally unleashes, what happens in those type of events is when the market has created a false reality, fooled people into thinking that's where it deserves to be, and when it wakes up, it not only goes to a new reality, but it often overshoots it, and it doesn't take years to get there. It often takes just a couple quarters of a massive tantrum. I think that's what silver is about to produce. Meaning, not only is it going to beat gold, not only are monetary metals going to beat the stock market, but silver could quadruple or even quintuple in a matter of a couple quarters after that spread breaks out, registering the breakout silver versus gold. Meaning, we might go up for a couple more years, and probably stay up there because the world is going to shift out of fiat currencies in this next crisis, is our argument.
Now let's pivot into what the next phase of this transition likely looks like, because the structural signals we're seeing in gold and silver aren't isolated. Markets never operate in isolation. They operate in relationships, and those relationships are shifting in ways that very few investors, even experienced ones, fully appreciate. Remember what we said in part 1. Momentum leads price, and spreads lead momentum. So if the gold versus S&P spread has just broken a decade-long base, that alone tells you we're entering a completely new environment. But the real acceleration, the kind that catches even seasoned observers off guard, comes when multiple spread structures break at the same time. And that's exactly what is forming right now. We're not just witnessing gold breaking out against the S&P, we're also witnessing silver preparing to break out against gold. And beneath that, we're witnessing the early formation of a breakout in the mining sector versus the metals themselves. These are not small events. These are interlocking structural triggers that historically have only occurred during major monetary revaluations. If you want to understand what's coming, you cannot look at a price chart and declare victory or defeat based on the last 48 hours. That's like trying to judge a marathon from 2 steps. This is a long-form structural rearrangement happening in real time. Let me give you an example that will crystallize this. In 2011, when gold ran to $1,920 and silver approached $50, the spread relationships had been signaling that move long before the public noticed. Silver had already outpaced gold structurally. Miners had already bottomed relative to gold. The spread chart showed the pressure building. It didn't matter that mainstream analysts said the metal was overbought. They always say that. Overbought is the vocabulary of people who don't understand momentum. When something breaks a multi-year base, especially a decade-long base, overbought stops being a warning and starts being a feature of the new environment. These moves aren't linear. They are rotational. They occur in bursts, not in tidy calendar increments. Let's come back to the present. The breakout in gold versus the S&P means money has already begun shifting into monetary metals and away from equities. It's not a future event. It's not a forecast. It's something that has already happened. That breakout was the shot fired in the dark before dawn. Now the light is coming. But here's what people misunderstand. Such breakouts don't just invite additional participation, they demand it. Once a structural shift begins, asset allocators, especially institutional allocators, have no choice but to follow it. They can't underperform their benchmarks. They can't ignore a trend that is mathematically pulling returns away from equities and toward metals. This is why it's so crucial that the public is still asleep on this. The public is in triple leverage mode on equities, all-time high margin debt, all-time high options exposure, and max commitment to the very sector that is now beginning its long descent relative to monetary metals. That misalignment is not a coincidence. Markets always create the largest imbalance right before the largest transition. Meanwhile, the insiders, the quiet capital, the deep-pocketed allocators, the sovereign actors, are positioning themselves into real assets. The deliveries out of COMEX, the massive drawdowns in LBMA inventories, the sovereign buying that nobody talks about publicly but is visible in the flow data. These are not the actions of bored investors. These are the movements of people who see beyond the noise. Now let's turn fully to silver, because silver is about to move from undervalued to mispriced, and from mispriced to something far more dynamic. When a spread structure like silver versus gold presses its upper boundary multiple times without rejecting downward, you are looking at a spring loading itself. Each attempt tightens the coil. Each failure to break downward confirms the buildup. And when it finally releases, the market doesn't walk, it sprints. This is why trying to time silver at the minute level is a fool's game. Silver is not a currency hedge you scale into using strict short-term timing. It's a structural hedge you position into before the energy releases. And when the release hits, you don't chase, you allocate beforehand. Silver is operating inside the same macro backdrop as gold. Debt expansion, declining confidence in sovereign bonds, monetary dilution, structural plateauing in equities, and geopolitical realignment. But silver has something gold does not: industrial penetration, solar, electronics, medical applications, energy transition, and emerging monetary adoption in non-Western markets. It is a dual identity metal, both monetary and industrial. And when the monetary identity and the industrial identity align, the moves are extraordinary. This happened in the 1970s. It happened in 2010 to 2011. And the conditions right now resemble both periods simultaneously. You have the monetary stress of the 70s combined with the industrial demand profile of the last decade. The market hasn't priced that yet. It can't, not until the spread structure confirms the move. But once it does, the repricing is abrupt, aggressive, and disproportionate. Let me address the miners, because many investors assume miners will forever lag the metals. That assumption is factually incorrect. Miners underperform metals during accumulation phases. They outperform metals during expansion phases. Structure tells us that miners are moving into an expansion phase. You can see the basing structure in the senior gold index, the junior indices, the silver miners. They all show the same multi-year compression. Not geometric compression, but structural compression, the type that precedes revaluation. When the miners finally break their own base structures, they tend to outperform the metals 2-to-1 or even 3-to-1 over the subsequent cyclical period. And because silver is preparing to lead gold, it follows that silver miners will prepare to lead silver. So the question becomes, where are we in the timing window? And for that, I return to momentum. Momentum is not the study of speed, it is the study of directional commitment. When momentum shifts from stable to positive across multiple spread structures simultaneously, market participants aren't just buying, they are reallocating their worldview. Right now, the momentum picture across gold, silver, and miners is exactly what you want to see before a multi-year expansion cycle. Remember, we aren't looking for short-term spikes. We're looking for the beginning of a long-term asset class migration away from financial assets and toward real assets. That migration is underway. Now, as we move into the next 6 months, expect volatility. Not volatility because of uncertainty, but volatility because of structural realignment. The deeper the compression, the more violent the release. But the overall direction is not ambiguous, not if you understand the models. Gold is breaking out of an 11-year base relative to the S&P. Silver is preparing to break out of its multi-year base relative to gold. Miners are preparing to outperform both metals. This is a trifecta of structural alignment that does not occur in ordinary environments. It occurs during monetary shifts.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.